Welcome to this explainer. Today, we're diving into a mystery you've almost certainly encountered. You know the scenario. You're driving down the highway, and suddenly you're right behind this gleaming, brand new truck that honestly costs more than some people's houses. You know the exact one I'm talking about. Chrome absolutely everywhere, leather seats that probably cost more than a month's rent, and a monthly payment that would make a mortgage broker weep. And here's the real kicker. The person driving it, they probably make less money than you do. So today, we're going to decode exactly how regular, everyday people are suddenly affording massive, luxury-level trucks that cost way more than the median household income, and why this mathematical impossibility is completely taking over our roads.
Okay, let's just jump right in by validating a suspicion you've probably had while stuck in traffic. You look at these $70,000 pickup trucks and wonder, did everyone around me get a massive raise? Well, spoiler alert, no. Your neighbors aren't secretly crypto billionaires or trust fund babies. They're regular teachers, mechanics, retail workers, office employees. Sure, the median household income has ticked up a bit, but nowhere near enough to justify these massive price tags using any kind of traditional financial wisdom. The math simply does not add up. So, how exactly does this whole system make this impossible math work?
To really wrap our heads around the scale of this, we've got to look at the raw numbers. The average new car payment in America has quietly blown past the $700 mark. And by the way, that's just for a regular, average car. But for trucks and SUVs, which have basically become the default choice for buyers today, the numbers get downright scary. $1,200 a month for up to 8 years? That's quickly becoming the new normal, and it's literally more than a lot of people pay for their rent or their mortgage.
Which brings us to part one, the dealership playbook, and the mechanics of impossible payments.
So how exactly do dealerships get folks to sign off on these massive numbers? Well, the first big shift is the loan term itself. Remember the days of a standard 3-year car loan, maybe 4 if you really needed to stretch it? Yeah, those days are completely gone. Today, lenders are routinely stretching loans out 6, 7, or even 8 years. Some are even offering 10-year car loans, which honestly sounds like a financial horror movie. If you take a $60,000 truck and spread it over 8 years, it drops the payment down to a manageable $900, and buyers just fixate on that lower monthly number, completely missing the fact that they're adding an extra $14,000 in interest over the life of the loan just for the privilege of a lower payment.
And then, oh man, then there's the other massive hook dealerships use to reel buyers in, the 0% financing offer. You see the signs everywhere, right? Free money? But the truth? 0% financing is practically a myth. The cost of that financing is just cleverly built right into the sticker price of the car. The dealer certainly isn't losing money. You are either paying the absolute full sticker price for the car to get that 0%, or you're taking a discount on the price and paying the regular market interest rate. You never get both. Plus, the folks who actually qualify for these super strict 0% offers, they're usually the ones who could just afford to pay cash anyway.
Now you mix those ridiculously long loans with our notoriously short attention spans, and you get what's known as the trade-in game. See, vehicles depreciate really fast in their first few years. So by year 4 of an 8-year loan, the buyer owes significantly more than the car is actually worth. But, they want a new car. So what happens? The dealer happily rolls that negative equity right into a brand new, even bigger loan. It creates his vicious financial hamster wheel where buyers are constantly rolling debt forward. They're making massive monthly payments for cars they literally traded in years ago, and the dealerships, they absolutely love it because it creates a captive customer for life.
All right, let's shift gears to part two, driven by identity, selling lifestyles, not transportation. Honestly, think about it for a second. If someone spent $1,200 a month on coffee, you'd stage an intervention. If they spend that much on clothes, you'd assume they had a severe shopping addiction. So why on earth is this totally normal for a car? Well, the answer is highly strategic marketing. The auto industry has masterfully normalized these crazy payments by completely shifting what it is they're actually selling. They're no longer selling a way to get from point A to point B. No, they are marketing that truck as a direct extension of your identity. It's a statement. It says you're successful, reliable, hardworking. When you see a commercial of a rugged truck conquering a mountain, they're selling you the fantasy that you're a mountain climber, even if the closest you ever get to off-roading is parking on the grass at the county fair. And this leads to a pretty fascinating and kind of scary psychological phenomenon. Let's call it automotive Stockholm Syndrome. The buyer actually becomes emotionally attached to their financial captor. Once you completely buy into the identity that the truck represents, that giant monthly payment stops feeling like a massive financial mistake and starts feeling like an investment in your own self-worth. Buyers develop this syndrome to the point where if you suggest they drive a cheaper, reliable used car to save hundreds of bucks a month, they don't hear practical advice. They genuinely feel it's a direct attack on their right to enjoy the fruits of their own labor.
Moving on to Part 3, Extreme Financial Gymnastics and how people are subsidizing the illusion.
Because look, emotional justification doesn't actually pay the bills. $1,200 is still $1,200, and the lengths people will go to just to keep that gleaming truck in the driveway, it's staggering. People are basically treating their car loan like a primary mortgage. We're seeing some extreme financial gymnastics here. Folks are moving into smaller apartments or keeping roommates way longer than they planned just to afford the truck. They'll literally eat ramen noodles while driving a vehicle that costs more than some houses. Some even engage in this bizarre form of automotive indentured servitude, taking on weekend jobs driving for rideshare companies, using their extremely expensive truck to generate the income needed just to pay for that exact same expensive truck. And worse yet, people are borrowing against their own futures, tapping into 401k accounts or taking out home equity loans just to fund this depreciating car addiction.
And if you think that monthly loan payment is the whole story, well, not even close. Buyers get so laser-focused on that single number negotiated at the dealership desk that they completely ignore the massive hidden costs of ownership. Just insuring a $60,000 asset can easily run you $200 to $500 a month. Fuel? For a heavy truck getting maybe 15 miles to the gallon, that can easily top $400 a month. And maintenance. Modern vehicles are incredibly complex machines. A simple brake job is over $1,000 now, and major engine work can easily exceed $10,000. People end up slapping these inevitable repairs right onto high-interest credit cards. They're essentially running their households like failing personal auto financing companies that are just hemorrhaging money every single day.
This brings us to our final section, Part 4, the devastating math and the true cost of ownership.
Okay, let's run the real, completely devastating numbers on a typical scenario right now. Say a $55,000 truck with a 7-year loan at 6% interest. The base price plus the interest alone comes out to roughly $67,000. Fuel over those 7 years, that's about $29,000. Insurance is going to cost you around $21,000, and maintenance and repairs will easily run another $15,000. When you add all those slices together, the actual price tag of keeping this one single truck on the road for 7 years, it is a staggering $130,000.
But here is the absolute most painful part of this math. At the end of those 7 long years of eating ramen, driving for rideshare on your weekends, and totally sacrificing your budget, what do you actually have to show for that massive investment? Well, the buyer's left with a highly depreciated asset worth maybe $15,000 if they're really lucky. Think about that. They spent $130,000 purely for the privilege of driving a $15,000 truck. You see, the real tragedy of this entire system isn't just the money spent, it's the opportunity cost of what that money could have done for you. Taking that same $800 monthly loan payment and just investing it into a simple index fund, earning, say, 8% annually, that would have fundamentally changed a family's financial reality. After 7 years, instead of a worn-out truck worth $15,000, they'd have over $70,000 in liquid, growing wealth.
So it really all boils down to this. That is not transportation financing. That is wealth destruction, just with cup holders and heated seats. This modern dealership system of extended loan terms, super strategic marketing, and constantly rolling negative equity, it isn't about making cars affordable. Not at all. It's purely about kicking the financial can down the road just far enough to sustain an illusion of wealth.
So the next time you're sitting in traffic and that gleaming $70,000 truck pulls up right next to you, you really don't need to wonder how they afford it anymore, because they probably don't. And it leaves us all with one incredibly vital question to ask ourselves. When you sit down to sign that dealership paperwork, are you actually buying transportation for your family, or are you sacrificing your future wealth just to look successful today?